Yo, welcome to a trade concept video. Today I'm going to be basically showing you guys examples of what an A plus setup is for me, and yeah, let's get right into it. So let me get things ready here. All right, so this is gonna be a video where you should watch my first my video over my day trading strategy. You guys should watch that video first before watching this one. They're confluenced with each other, so the very first one that you should watch is the day trading strategy. So it's the prerequisite before this video. So before I even get started, I want to say you should watch my day trading strategy first on my YouTube channel. After you guys have watched that and understand what my model is, then you should come over to this video and finish out this video. I'll give you guys 5 seconds to do that. 5, 4, 3, 2, 1. Well, whoever's still here, let's get right into it. So the first example of a plus setup for me is a trade that occurred during July 3rd, 2024 trading day, actually. So coming into today, this trade is based off of a 30-minute power of 3 here and a 15-minute power of 3. Our higher time frame draw was the previous month's high, and I based this trade based off of this 15-minute power of 3 here. So notice how I don't take the initial entry. I don't take my initial entry at the 15-minute fair value gap. I wait until we can get some sort of reaction to it. So we retrace into a 15-minute fair value gap, correct? And I also note out, hey, we closed on this 30-minute candle. We had a pretty, bullish 30-minute candle. And so I was anticipating for us to take out this 30-minute candle's high. And after how this 15-minute candle is closed, I was also anticipating the same thing, to take off that 15-minute high. So we have a 30-minute high and 15-minute high, and they're in confluences with each other, so they're aligned. So we have two time frames that are aligned with each other, and our higher time frame draw, which is the previous month's high, hasn't been taken out yet. So like on the daily, weekly, and monthly, it appears that we are going to take out previous month's high today. So there's the idea of fractality. I don't know what it is, but the markets are fractal, basically based on what ICT states. So the same model here, us retracing into that 15-minute fair value gap, occurs on the 1-minute time frame. So here, zooming into the 1-minute time frame, note out that 15-minute high and 30-minute high. So those are my draw of liquidity on the 15 and 30-minute time frame, right? So now all I'm waiting for is prices to retrace back again. Notice how I'm waiting for so I'm also waiting for this retracement, right? I'm waiting for this retracement to see if we're gonna price higher from it. But it's the difference between this retracement here is that I'm actually willing to take the risk for it, because now I've mitigated my risk and I don't actually take my initial entry at the 15-minute fair value gap. I already stated this, and because I'm trading on the lower time frames, this allows for me to mitigate my risk, and it allows for a tighter stop loss. So if I were to enter based on this 15-minute fair value gap here, my stop loss would have been maybe double what I had my stop loss on the 1-minute time frame. So instead of it being a 10-minute or 10-point stop loss on the 1-minute, if I traded based on the 15-minute model, it would have been maybe like a 20-point stop loss, which is 2 times the amount of points there is of movement. So trading on the lower time frames allows for precise entries and allows you to, as traders, mitigate risk. So the same model here occurs as well. We retrace back into the 2-minute FEG targeting the 15-minute high. So after we take out the 15-minute high, I'm moving my stops to break even, and I take off a partial there, and I also take a partial at the 30-minute high, and previous month's high is my terminus. So that's one example of an A+ setup for me. It's like I said, we have the higher time frame draw, check. We have multiple time frames in alignment, check. I understand why we created that power of 3. The reason why we created this bullish 15-minute power of 3 here is because we retraced back inside of 15-minute fair value gap, and we had a reaction to it. So that's checked off. On the lower time frames, we have the same model, but like I said, it's on the lower time frame. So that just shows you how fractal prices could be. So check. That is an A+ setup. This right here, I will take every single time I'll see it. I do have a a video up on my YouTube channel, and there's the same model occurs as well, but instead it's a losing trade. And like in that video, I state, if this setup were to occur 10 times, I would take it 10 times. This is like my ideal trading model. Some people might have backtracking to the 15-minute time frame. Some people would have taken the entry based on this 15-minute fair value gap, right? And let's just say that we retrace back inside this 15-minute fair value gap, and we instantly take out previous month's high. No retracement on the lower time frames. What am I gonna do? I'm gonna sit out again. I'm gonna sit out on the markets and sit on the sidelines and just watch price action. There's no point of me, pulling the trigger. My setup didn't occur. My bias is correct. There's no point in me. I don't feel if I'm correct or not. It's just if that model presents itself, I'll take it. And in this case, there is a model that presented itself, and I took it. One thing to note is that I'm buying below the 11:45 open. ICT states, or he made like a whole 50-minute video talking about the midnight opening price and why it's important. And basically, he's applying that to the daily time frame. So whenever you anticipate a expansion date, so let's say we're bullish that day, you want to be buying below the midnight open. So you always want to be buying below the open or selling above the midnight open. That's just on the daily time frame. But if you apply that to every other time frame, it works the same way because prices are fractal. Like I said in this example here, this is the higher time frame, but we're doing the same thing. We're rebalancing a fair value gap to continue higher, and this is on the 15-minute time frame. It occurs on the 1-minute time frame as well. We're rebalancing a fair value gap, and so I take that idea of that power of 3 taking the midnight open. I just applied that to the 15-minute time frame. I noted out the 15-minute open, the new 15-minute open, and I just, like I said, I want to be buying below it, and I actually bought below it. I bought whenever prices retrace into that 2-minute fair value gap. So consider the opens whenever you're taking a trade. And the second trade that I do have is this one actually occurred July 15th, 2024. So about a week has passed since the first example. So the second example here. So this example, we've closed above a hourly SIBI, right? So what does that tell me? We're bullish. We're disrespecting a higher time frame bearish PD array. This PD array here should have sent us lower, right? But we disrespected it. So, and look how clear it is that prices wants to take out previous day high. So previous day high is the clear draw of liquidity for me. So on the higher time frame, we have previous day high being the objective. We've closed above a 1 hour SIBI. So now I'm going to go onto the 15-minute time frame to get more confluences and get more reasoning on why I should even take that trade. So now based on the 1 hour and 30-minute and 15-minute power of 3, what can we anticipate for us to take out their respective highs? So we have 3 time frames that have the same objective. So that's time frame alignment. That's the second aspect of my time frame concept that I've created. Well, not that I created, that I've ICT teaches it, but he doesn't teach it like, he doesn't give a clear he doesn't teach it clearly. He kind of makes us like kind of piece the puzzles, but I feel like this is what he means by time frame alignment. If the time frame has the same objective, it's more confluence for that trade. So like I said, all 3 time frames I can anticipate for us to take out the highs, but I'm not going to enter that trade based on that, you know, idea alone. I need a PD array, an entry pattern, for me to actually take it. So I note out, okay, we're probably not going to retrace into this 30-minute fair value gap based on how we closed here. I talk about that more on my fair value gap theory and why I believe this 30-minute fair value gap here is a breakaway gap. And I also, same thing here on the 15-minute time frame, I talk about why I believe this 15-minute fair value gap should be treated as a breakaway gap. So I don't expect prices to, or anticipate prices to retrace and take out this low first. I anticipate for us to take out the highs, right? So I'm thinking, okay, so the 15-minute, we're not going to retrace onto the 15-minute fair value gap or the 30. Let's go on to an even lower time frame to find an entry. So on the 5-minute time frame here, we have a 5-minute fair value gap, right? And this fair value gap supports the idea of us taking out that, you know, hourly high, 30-minute high, and 15-minute high. So I take my entry whenever prices retraces back inside that 5-minute fair value gap. So on the 1-minute time frame, it shows a little bit more clear, but we retrace into that 5-minute fair value gap, and instantly we take out the 15-minute high. We take out previous day high, which is that 15-minute high is essentially the 15-minute, 30-minute, and 1 hour high, and we take out previous day high as well. So you know, it was an in and out trade, like real quick. I take off about half of my positions off at the previous day high, and then I remember this trade. I set up standard deviations from, you know, the swing low, this swing low here to this swing high, and I just took off negative. I took off some more partials at the -1, and then I ended up taking off my full position size at the -2 standard deviation. And notice, I want you guys to notice here, look at how prices respects the -4 standard deviation. We reverse at that -4 standard deviation. It's not guaranteed all the time. Not all the time this will happen. It's just, you know, sometimes, you know, it will occur. But yeah, those were the 2 A plus trades that I have, and that I really want to, you know, put out, because like this to me helps me understand, okay, I know what my A plus setup. If I can explain to you guys what an A plus setup for me is, then I have even more, you know, now I have even more insight and more perspective on what an A plus setup for me. This is gonna help me and you guys understand what my A plus setup trading or A plus setup is, and I want to go over this setup that I took here today. So today is July 24th trading day, and the setup I took today here was so based on this 30-minute candle here, right? This is a 30-minute candle right here. So based on this 30-minute candle, I can anticipate for prices to take out this candle's low first, right? So I'm anticipating for us to take out this 30-minute candle's low and leave this 30-minute SIBI here as a breakaway gap. Like I said, I explained that more in my fair value gap theory, but yeah. So we're bearish on the 30-minute time frame. On the 15-minute time frame, this is the candle I based my trade off of. This one right here. So notice how this line is basically that 15-minute low. Notice how we retraced into a 15-minute fair value gap, right? Like I said, I don't take my entry simply based off of that 15-minute fair value gap. That's not how I trade. I like to wait for the reaction of the 15-minute fair value gap first. So after we had a bearish reaction to that 15-minute fair value gap, we have now time frame alignment. Now we have the 30-minute being bearish, and we also have the 15-minute being bearish. So I go onto the sub 5-minute time frame to find a PD array that would support the idea, right? So on the 5-minute time frame, we don't necessarily have a fair value gap to enter off of. The 4-minute doesn't have one either. 2-minute, 3-minute, 3-minute, no. 2-minute, no. But on the 1-minute, yes. So this is that 15-minute low right here. So notice how it lines up to this 15. So this is the 15-minute time frame. I like having these candles to the right of me just so I can understand what the higher time frame is doing, like relative to the 1-minute, because it just keeps me aligned, and I'm not super tunneled here. So like I said, that 15-minute low is my basically it's my break even. I don't take any partials off there, but that is essentially where my break even. I move my stops to break even. So there's a 1-minute fair value gap, right? Notice how fractal it is. We retrace. I don't take my initial entry on the 15-minute fair value gap, but on the 1-minute time frame, prices does retrace into a 1-minute fair value gap. And this one, I can actually base my trade off of. And I already explained the reasoning, but let me explain it one more time, just so you guys can like really understand why I'm not actually taking the entry at the 15-minute fair value gap. As day traders, the whole concept of being a trader is basically we're professional risk managers, right? Here, if I were to take the trade based on this 15-minute fair value gap, right? And note, every trade isn't a guaranteed win. It's a game of probability, and whenever you mitigate risk, that's when you actually understand. That's when you're on the winning side of the game. This game isn't about being correct or not correct. It's being profitable, and risk management is basically like the 50. So it's psychology, technical analysis, and risk management. In here, let me go back to what I was talking about, the not entering off of the 15-minute fair value gap. Look at the risk that I'm gonna have to incur, that I have to respect. 20 points, basically 21 points here, if I were to take the entry off of this 15-minute fair value gap. And I'm being really nice about my stop loss. Usually whenever I do take a stop loss, set my stop loss, it's at the fair value gap high. So this is a 15-minute time frame, right? This high right here should have been where my stop loss is. If I'm being like, really objective here, 38 points is my risk if I were to take this trade. That's not this is not what I want to do, right? But the fact that the market is fractal means that the same setup occurs on the lower time frames, and this allows for risk management, lowering your risk. So we have the same model here. We retrace back inside of a 1-minute fair value gap, and look at the risk difference. 38 point difference here. We had 38 points to risk here, but this one I only have 8 points to risk. That's 32 points. That's the differential, right? This is why being an intraday scalper is a little bit, you have more wiggle room. Not necessarily more wiggle room, but you have more of exact, precise executions. So I take my entry based on the 1-minute time frame, because I'm actually I'm willing to risk this amount of points. It's only 8 points, and it's the same model. So that's the trade that I took today. I don't know if my thing will actually show you guys executions, but there's the executions. So I bought 7. I sold 7, sorry, and I bought move stops to break even after we take out the 15-minute low, and then there and done. It was actually, you know, in and out setup, but yeah. And with that, that's gonna be all for the video today. I appreciate you guys for watching, and I hope you guys tune in again for another video. Peace out.
Bam.